Hi everyone, it's Amit. So 2020 has been nothing but ordinary. Okay, we've been dealing through with a global pandemic. There's been some challenges in the transition in the U.S. presidency. We've experienced multiple lockdowns. Unemployment has at various points during the year been in the double digits in the U.S. So there's been a lot of things that the country has been dealing with. And one would naturally assume that with all of these adverse things that are happening, the equity markets or the stock market should also have been adversely impacted. But when you look at the data, right, you'll see that the stock market has actually had a great run up. Over the last 12 months, the run up in the stock market, or in the S&P 500 more specifically, has been 18%, right? And on an average return basis for the S&P 500 is about 7 to 8% annually. So this is a significant increase, even on a comparative basis, between the historical returns on the S&P 500 relative to where we are today. So what's driving this, right? So those are some of the questions that I wanted to address. Is one, what is driving it, and is the valuation in the S&P 500 justified? Two, are the stock market and the economy linked? And three, what can we expect to see in 2021? And then we can make some investment decisions associated with it. So those are the three questions that I wanted to answer in this video. So let's get started. So in my view, 2020 can be broken down into really two periods. Okay, there was the period from February through, say, October, which is when the pandemic hit and people didn't know what to do. Okay, and then there is the period after November, which I call the partly cloudy period. And let me go into a little bit more in terms of why I'm defining it in that way. So I call the initial period, the February to October period, the foggy period, is because the market or the economy and the federal government, and for the most part, everyone did not know what to expect. Okay, no one knew what to expect when you do a lockdown of the economy and what the outcome of that is going to be. Okay, we have no experience in that space. If you don't have any experience in that space, you're probably not going to know what the outcome of it is going to be. Then there have been lots of things. So then government started printing all this money. We had all of these stimulus plans that happened. So a ton of activity. Companies were still going belly up. There was the PPP plan to basically help companies to get some money. But with that said, retailers still went down, and it kind of goes into this conversation about, well, maybe not the right people got their money and so on and so forth, but I'm not going to go into that piece of it, right? But, there's been a ton of things that are happening, and it resulted in a fair bit of unclarity as it relates to the market, right? Is the market going to go up? Is it going to go down? One would think, just a gut reaction would be, oh no, it should drop, it should go down. But that is not what happened. And the market went up somewhere between 6 and 10%. Like between last year, late November, and this year, early December, the market's been up 18%, right? So something has obviously happened. But that's why I call it the foggy period, in terms of there is lack of clarity. And then I call November period on to be the partly cloudy period. I haven't gone all the way out and said that, hey, it's this more optimistic, partly sunny or sunny period. And the reason for that is, while there is more clarity in the system, okay, we do know who the president is going to be in the United States in 2021. We do know that there are various vaccines in the trial stages at this point in time, right? And they're trying to get FDA approval, and some of them are in emergency approval, and there's a fair bit of optimism around that. I think there's several questions as it relates to the specificity of some of those positive things. So, for example, when it comes to the Biden presidency, right? He's laid out his proposals. He's laid out all this stuff, right, which was all a part of the election process, and we've covered off on that in a separate video as well, right? He's laid all of these things out, but the question is, well, when will some of those policies actually become law? Right? Will they even become law? We don't have visibility into that. The other thing we don't have visibility into, as it relates to the vaccine, as an example, is we don't have clarity into, okay, when is this vaccine actually going to be distributed? I've heard lots of things, right? I've heard, obviously, emergency distribution. It could happen just before 2020 even ends, right? I've heard of kids getting their vaccines probably in Q3 of 2021. Okay, I've heard other articles that talks about distribution happening in April, May, June. So I've heard about a bunch of things, but I think some of the logistics and all of the stuff needs to essentially get figured out yet. Okay, so there is some level of uncertainty as it relates to the specificity, and due to that, I'm calling it more of the partly cloudy period. So let's take those one at a time, right? So let's just talk about the foggy period initially. Okay, So when it comes to the foggy period, right, that is when one would expect the most amount of market uncertainty. And to be frank with you, we did experience a significant amount of market uncertainty. March, when this issue was initially rising, there was a precipitous decline in the market, and the market has been coming up for quite a while. So, what has been driving that? And I think one of the key things of what the data would show is that the market's been coming up, but it's not been a broad S&P 500 type of rally, especially in the foggy period. In the foggy period, there were only certain sectors, and more specifically, certain companies that were essentially pulling the S&P 500 up. So everyone or most people are aware of the FANG stocks, right? Your Facebook, your Apples, your Googles, your Netflix, and people are obviously aware of Home Depot, Walmart, Target, those types of companies as well. These companies are significantly large companies with huge market capitalizations. When you have companies with such significant market capitalizations that are doing well, it's going to pull up the S&P 500 primarily because of the way the S&P 500 is calculated. The way the S&P 500 works is if you have large market capitalization companies doing well, just to keep this as simple as possible, if they're doing well, then the market's going to go up. And that's exactly what's happened. Okay, so if you want to put some numbers behind this whole thing, the energy sector was decimated in 2020. Okay, it was down 46% during this foggy period, right through, say, September or so. Financial services was down. It was down 19%. Utilities was down 8%. Real estate was down 6%. So those are all the sectors that did poorly in the foggy period, right? And then there were sectors that did well. For example, technology was up 26%. Consumer discretionary was up 22%. Was up 9%. And all of this makes sense, right? It makes sense why certain sectors and certain companies did better and significantly better as people have stayed home. They've had to figure out new ways to communicate with others, to shop for whatever it is that they need. They've had to come up with new ways to do these things. And in order to do these things, you've had to embrace technology in some way. And if you can embrace technology, naturally the companies associated with that are going to do well. So that's where Amazon comes in, and they've had this banner, absolutely banner 2020. Now let's briefly touch on the partly cloudy period as well. Okay, so during that period, the market has accelerated from a growth perspective. The reason for that is relatively simple, right? So the market is forward thinking, it's forward looking, right? It's not thinking about today, tomorrow, it's thinking about 6 months from now, it's thinking about a year from now. And what it's basically concluding is that due to all the optimism that we have talked about, even though the specifics may be a bit gray for all intents and purposes, right? The market is basically thinking is that the market's going to do very well, okay? So it's been more of a broader based rally since November, since the clarity has basically been received. So for example, travel and entertainment and hospitality, all of these sectors have started participating as well. Industrials, Boeing, they've all started doing well also during this time. So they're bringing more and more companies into the fold, and they're all starting to rise, and that's what's driving the market even more. Now, you may think that, hey, perhaps the technology companies should slow down a little bit, right? It should slow down when during this more clarity period, and that's because, hey, if you know these things are going to happen or these things are going to transpire, there's going to be more people getting out and doing stuff for all intents and purposes. Then perhaps they're not going to be buying so much on the internet, and perhaps they're not going to be communicating as much on the internet. And I think that's a fair point, right? And I think from November on, that tech sector, it's been still growing, right? There's no dispute around that, but it has slowed down a bit, right? So I think that is an indication. But I also think the way several market pundits are viewing this is the pandemic in itself has created a seismic shift in the way people are going to be buying and their adoption of technology, and the adoption of technology has significantly accelerated. When you start thinking about it in that vein, then it creates more visibility into why we think that the technology sector will continue to blossom even into 2021. Then there's other reasons for the run-up in 2020 as well. So interest rates are at an all-time low. Okay, and the Fed has come out and said that we're not going to bump up rates for a long period of time, at least until 2023. So when you have that kind of commentary, there's really no other place to put your money. You will put your money in the stock market because you're not going to get anything for putting your money in a bank account. And you're not going to get anything, or it's even going to be adverse if you put your money to a bond fund as an example. So when you have more and more people just running and putting money into the equities market, and you have new trading platforms like Robinhood that are out there that are involved, that are allowing for like fractional buying and allowing more and more people to enter or participate in the market, when you have those types of things happening, it's going to obviously drive up the equities market as well. So that's another large reason in terms of why the market is experiencing the run-up that it has. To answer the question, right, is the run-up in the S&P 500 justified? In terms of the way calculation is done of the S&P 500, right, and how influential companies are with large market capitalizations, I think the argument can fairly easily be made that the run-up is justified. But I do think that we are entering this period where there may be some level of overvaluation due to some of those Robinhood investors and people not knowing where else to put their money, so that they're just dumping it into the equities market irrespective of what the fundamentals are. So I think there is some of that is absolutely happening. Okay, and when you have that kind of thing happening, it's going to create some level of froth and potential overvaluation in the market. Now, I don't think we're at a significantly like a risky period, like we're overvalued like what we've been back into some of the other crashes that we've experienced in the past, but we are definitely hitting several metrics as it relates to potentially having some level of overvaluation in the equities market. So that was a tougher question, right? So now let's do some of the easier questions. Okay, the easy question is, well, so are the stock market and the economy linked, or are they correlated? At least from my perspective, I think in the short term the answer is no, in the long term the answer is yes. Okay, and the reason why I say that is if you look at some of the data points around it. Over the last few decades, right, there has been actually a precipitous decline in terms of the number of companies that are listed on the stock exchanges. Okay, so if you look back at 1996, there were some 8,000 some odd companies that were listed. And if you look at 2016, the number was closer to like 4,600. So that's, somewhere around a 50%, close to 50% decline in the number of listed companies. There's lots of private companies, restaurants, there's other retailers, all private, right, that employ tons and tons of people, tens of millions of people. They're not all working at a publicly traded company, and that's what's getting the economy running, right? So when you have that kind of a fact pattern, there is just naturally going to be this level of incongruence between how the stock market is performing and how the economy may perform. Those tens of millions of people that we're talking about are the ones who have been naturally hit or directly hit due to the pandemic. Those are the folks that are experiencing the unemployment. Those are the folks that are dependent on the stimulus checks. Those are the people that actually need the help from the government, and make sure that money on these stimulus checks actually makes its way to them. But when you have that level of disconnect, right, the stock market and the economy are going to be incongruent with each other. They're potentially going to move in different directions. And as you have these millions and millions of people who are, suffering or are dealing with this adversely, their demand for products is going to naturally decline as well, and it's going to create some level of choppiness in the market. But in the interim, at least, those big companies that, in the technology sector and the consumer discretionary sector, they're going to continue to do well, right? They're going to continue to move forward. And that's going to kind of like increase the divide unless this vaccine distribution and people get out and start supporting the economy and all this stuff kind of like happens, right? So that's why I say that the economy and the stock market, the differences in terms of what people are experiencing is significant over the long term, right? The economy, and here I'm measuring it in terms of GDP growth, right? The economy and the stock market do get more correlated, right? They do more move up together over large spans of time. So let's address the third question, right? The third question is, what can we expect? So in my view, I am thinking about this more 12 months perhaps, right, as opposed to thinking about this in the immediate, like what's going to happen next month, what's going to happen today, tomorrow, or the next couple of months here. Because as I mentioned, I do expect there to be some level of turbulence in the short term. I think this whole stimulus check in itself is creating a bit of a problem, because there's just lack of clarity in terms of when that stimulus check is actually going to get pushed out and how it's going to get pushed out, and ensuring that the right people get that stimulus check as well. So taking into account that short-term kind of choppiness or turbulence, I think in the long term, people have a lot more to be optimistic about. Interest rates will continue to stay low based on some of the Jerome Powell comments, the Fed chair comments on interest rates staying low until 2023, right? So when you have something like that, there's not going to be any other place to put your money, and people are going to continue to put it in the stock market, which will drive the stock market up. So that's one reason. The second reason is just more sectors will open, right? So with travel and hospitality, entertainment, some of the industrials, hopefully, we may have an infrastructure bill at some point in time here. And so it's going to continue to drive a lot of these other sectors up. And if it drives those other sectors up, it's going to be very beneficial for the equities market when you have more and more market participants in it. The Biden presidency, in addition to like an infrastructure bill, hopefully it'll result in some level of softening when it comes to the stance as it relates to the tariffs. Now, I don't think we're going to see anything in the immediate future with respect to China and the tariffs associated thereof. But I think this whole tariffs conversation is something that people are more optimistic about, especially under the Biden administration, because I think what people are expecting is the U.S. will start exerting its influence in the global stage again, and as opposed to looking more inward, as was arguably the stance under the prior administration. And the last thing is just around innovation, right? So I think the technology companies will continue to innovate, right? And there's going to be new ways of people actually doing work, right? Efficiencies are going to go up. I think the whole pandemic has somewhat accelerated the need for technology and the need for efficiency and the desire for incremental efforts as it relates to innovation. So when you have things like that, it's going to result in a significant amount of productivity increase. And when you have those types of things happening, you can kind of see a rise in the equity markets as well. So I think there's a lot to be optimistic about. So in conclusion, just to do a quick recap, right? So we've talked briefly in terms of, is the valuation in the S&P 500, or at least was its uptrend, justified? And I think the argument could be made that, yeah, it is justified. In terms of the question of, are the market and the economy correlated, I think long term they absolutely are, right? Short term, there needs to be more discussions to be had in terms of whether that is actually the case. But I think a reasoning is a very simple talk track that can basically allude to the notion that no, they're not going to be linked in the short term, and there's going to be some significant differences between how the economy reacts and how the stock market reacts. And I think we've covered up how should people be thinking about it from an investment perspective, where at least in my view, there should be some optimism and people should continue to contribute into the equity markets and stay risk on. But I'm very interested in hearing your views as well, right? I mean, what do you think is going to happen with the equity markets in the short as well as in the long term? Please include those in the comments below. So if you would like to see more videos related to personal finance, go ahead and hit subscribe and also ring the bell. If you ring the bell, you'll be notified as I release any new videos. Thanks everyone for watching, and I will see you soon.